What is up, traders and aspiring traders? I am Jay from EatSleepProfit. Before we get to the video, I just want to talk about my content, my videos and stuff. I keep everything free. I'm not trying to sell you any type of DVDs based on me just screen capping my screen and talk about trades and blab and trying to self-promote myself. I'm actually giving you real content that's free. I just want to know if you guys like it. If you like it, you can subscribe. Just let me know if I'm actually still doing good. Anything you want to change, anything you want me to talk about. That's all it is. So to keep this free content still going, let's roll into the next episode. Now, welcome to our Day Trader Beginner Series. This is where we're going to be covering all the strategies, the how-tos, basically everything you need to know to become a better trader. Now, the first topic for this episode I've chosen, and it's going to be the most important one. So if you don't watch the rest of the series, this is really going to be the most important thing. You can just watch this video and you'll probably be way more successful at trading than I am, because I don't even follow my own rules. So the fact is, what you really want to know and what I'm going to really show you today is how do you know when to buy and when to sell, and how do you know when to short sell. So these are the two main things that you need to know, especially to know when to execute your trades. Like, when do I know when to press that buy button? When do I know to press that sell button? How do I set everything up? And how do I basically judge these trades from there? And that's all you're really going to learn in this video. Now, I have two different trading styles, and these are my keys to success, really.
Some people can't handle success. I can.
The first one is momentum trading, and the other one is swing trading. In a short sense, momentum trading is like riding a wave. You're riding the increase in volume and price all the way to a resistance level or whenever you choose to get out. Now, swing trading is like riding the wave, but it's slower, and it's over multiple days, which gives you the same amount of potential percentage increase, but without the increased volatility. Now, 80% of my trades are going to be momentum and day trades, just because I don't like holding overnight. Most of you small accounts are going to need to hold overnight just because you need all the help you can get. 80% of my trades are going to be momentum and day trades. Most of you guys' trades are really going to be, it's going to be half and half momentum, half swings usually. It can change. There's really no perfect percentage what you're really supposed to have it. It's wherever the market goes, really. Now, the precursors to momentum trading is you're going to need a scanner, and you're going to need to be able to watch the market closely, especially for the first 30 minutes of trading. Now, if you want to know my scanner parameters, I'll just put it down here. I have a link to my old video where I actually talk about the scanner and how I set mine completely up. Now, what I look for is gap and go stocks. Gap and goes is exactly what it says. It gaps and it goes. Now, these are very common and basically stocks that have a very strong pre-market volume and price change accompanied by it running once the market opens. It can run in either direction. It can run up or it can run down. Luck of the draw, really. A lot of these stocks have a low float or available public shares, so when the buyers come in, you can really see tremendous gains in a short period of time. Now, all float is the amount of shares available to the public. If you learn about in basic economics and supply and demand, if there's a small supply and there's a high demand, the price goes up. If there's a large supply and a low demand, the price goes down. Same thing happens with stocks. So how would you trade a gap and go stock? First, you need three things, sometimes two, but mainly you need three things. Most important, you need above average volume for the stock. Also, you need a good increase in price to justify the momentum and a catalyst of some sorts. The catalyst is really that determining factor where you can either have two things or three things. Now, with catalysts, I like to look for earnings winners, contract winners, mergers, some form of big news that can last over multiple days. Now, catalysts aren't necessary in price or volume, but they play a good role. They validate the price action. Now some stocks can be pumped up by your favorite gurus or email alerts or whatever these things, however they get pumped up. They can be pumped up and you can trade those and still win. But the fact is it's a little bit safer to trade something with a catalyst just because it is some form of validation. That means the news outlets are actually talking about it, and that's more validation in the process. Now, once the market opens, I'm looking for resistance levels that are psychological and are of previous trading resistance. From there, I have a relative notion of when to get in and when to get out and my risk reward. I at least want a 2-to-1 risk reward ratio, which means I'm risking 20 cents per share of downside while I'm looking for a 40 cents per share of upside potential. Now, next thing I'm looking for is just buyers to pour in, and this is purely up to luck. There's really no system where you can really know if buyers are going to come in, or you can predict that. It's all up to the luck of the draw. Now, I never buy out of the gate. And that is the stupidest thing you can ever do. It's a lot of beginner mistakes, and you can't knock beginners for doing that. It's just like as you trade on and as you get more experience, you can't really keep on buying out the gate because you will always get screwed over like that. Since there is no price action to judge the trade, you might as well just be trading blind. Now, what I wait for is that first powerful green candle, and this is my entry. I get in when the candle has a pullback or when it continues to the next. What you really don't want to do is chase a stock 40 to 50 cents above the support level, since if you want a 2-to-1 risk ratio, you have to aim for 80 cents to $1 in gains before it's even well worth it. Now, once I'm in, I'm aware of previous trading resistance and even resistance levels like $1 per share, $2 per share, $3 per share, etc. Now, what I look for to get out is overextension. If I'm in a trade and it spikes in one candle, let's say $1 per share, I'm taking profits off the table. Now, it can go farther than that, but I'm not really going to risk that. I also look for sideways action or consolidation to take place. This is a sign of indecision, which means I'm not about that life, and so I'm basically going to jump ship. Anything above 2-to-1 risk reward is just icing on the cake. So don't push it. Don't be aiming for 3-to-1, 4-to-1. Don't be aiming for 1,000% in one day.
Some people can't handle it. I can.
Take your profits early and get out. The one thing, if you can just keep this motto, and if you live by it, I guarantee you half of you guys will probably actually start to see profits. You don't make profit until you hit the sell button. If you take that into heart, if half of you guys will probably actually stop losing trades.
You smart.
Now, if a stock takes off and for whatever reason you did get in, not all hope is lost. Now, what you want to look for in a situation is called flag patterns. These are patterns associated with bullish or bearish movement. Now, a good rule to follow is the higher the stock is relative to the open, the smaller of a position you want to hold. This is how you manage risk reward. Well, what about if a stock is falling? How can I profit from those? Now, that's when you have to execute a short sale. Let's briefly talk about short selling. Short selling basically is selling the shares from your broker that you have borrowed and you sell them at a price. Next, you want to do is buy back those shares at a lower price and make the difference. And that's all short selling really is. It sounds complicated. People explain it very complicated, but it's a simple concept. Now, what you always want to remember when short selling is the potential loss is basically unlimited. If the stock goes higher and higher, let's say the stock goes from 1 to 100, that's very, very, very unlikely. But let's say it goes from 1 to 100, you have to buy back those shares at $100 per share, which means potentially your loss is unlimited. Rather than if you actually long a stock, like you normally buy first and sell later, your potential loss is just your initial investment at max. So let's say you invest $3,000 into a stock. The most you can lose when you long a stock is $3,000. Now, if you short sell, you can lose $10,000, you can lose $100,000, you can lose $1 billion if the stock somehow does that. Which, I mean, that really doesn't happen. And there's margin calls, which basically means if your loss goes to the point where it's more than what your account is worth, then they'll just jump you out of the trade. They're like, yeah, you're not going to completely destroy our money because it's on margin. It means it's borrowed money from the broker. With Thinkorswim, my broker, all you have to do is sell the stock before you buy it, and it executes a short sale. One thing you never want to do is short sell into strength. That combined without a stop loss basically can destroy your account in minutes. I like to short sell overextended stocks, basically stocks that are up consecutive days of long positive price action. Think of it as a plane taking off. If it gains altitude too fast, it can stall and crash. If it ascends slowly, it can climb to cruising altitude. Well, as bad as it sounds, I'm basically looking for a plane crash to happen. In a sense, each passing day is more likely short potential just because it's overextension. This is when I look for the green or red crash. Now, when do I know when to cover my position? I just use the same rules as longing, using the same risk reward and stop losses. Also, I keep in mind psychological and past trading support levels. What's neat about overextension is as fast as they grow, they fall twice as hard. Since shorters mainly induce panic, since you can see 3 days of gains getting destroyed in basically a couple of hours. What makes short selling so overpowered in this sense is that if sellers are rushing to get out and short sellers are trying to profit on the breakdown, the market just sees a ton of sellers rather than normal sellers and buyers. This is where the panic drops happen. What's good about learning short selling is that you can make profits on the upside of and the downside of a stock, so basically doubling your net profit. This is how you can pull a $10,000 week like I've done plenty of times. Now, this should give you a good in-depth look at how I buy and how I sell and what I look for.
I appreciate you.
Now, always, I'm going to be making more and more videos going in depth of what I do every single day. Any type of questions you have, you can email me. You can hit up my website. I have a whole bunch of information on what I do. If you need help, if you need mentorship, if you need any type of aspect of trading that you need help with, I got it. Any type of, if you just need questions, if you want your questions answered, just email me. Get on Instagram, comment, DM me or whatever. I'll be able to answer anything that you have. This is Jay from Eat Sleep Profit. Let's get it.
Another one.